Welcome to our comprehensive guide on Oregon tax residency. If you're planning to move to the beautiful state of Oregon, it's essential to understand the tax residency rules that can significantly impact your obligations. The picturesque landscapes and Oregon's absence of sales tax make it an attractive destination for many, but the state's unique income tax structure requires careful navigation. In this video, we will explore the key factors influencing tax residency in Oregon, ensuring you have the knowledge to establish and maintain your residency status confidently and compliantly. Let's delve into the primary factors that determine your residency status in Oregon. The state considers you a resident for tax purposes if you're domiciled there or maintain a permanent home while spending at least 200 days within the state during the tax year. This critical 200-day threshold distinguishes Oregon from many other states, which often use a 183-day standard. Understanding domicile versus mere residence is imperative, as domicile represents your true permanent home, while you can have multiple residences. This is especially vital for those who split their time between Oregon and other locations. The unique 200-day rule is a cornerstone of Oregon's tax residency status. If you have a permanent abode in Oregon and spend 200 days or more in the state during the tax year, you are classified as a resident for tax purposes, even if your domicile is elsewhere. For example, if you own properties in both Oregon and California, but reside in Oregon for more than 200 days, your tax obligations will fall under Oregon law. Tracking your days is essential for anyone considering residency, particularly if you're dividing your time between states. For those transitioning in and out of Oregon, understanding part-year residency is crucial. If you moved your domicile either into or out of Oregon during the tax year, you will file as a part-year resident, potentially using Form OR40P. Succeeding in this status means you will only be taxed on the income earned while you were a resident. Conversely, if you're living in another state while earning income sourced in Oregon, you're a non-resident and must file Form OR40N, paying taxes only on that income. This bifurcated approach necessitates diligent record-keeping of both residency dates and income sources. Lastly, let's touch on the considerations for military personnel and digital nomads. Military members have special protections under the Service Members Civil Relief Act, allowing them to maintain their original domicile while stationed in Oregon. On the other hand, digital nomads must be cautious. Spending significant time in Oregon can unintentionally classify you as a resident if you exceed the 200-day rule. Regardless of your situation, keeping thorough documentation of your presence in Oregon is vital. Leveraging technology, like location tracking applications, can ease this process and ensure you stay compliant with state tax laws.